All right, let's talk about the stock market. We're going to cut through all the jargon, all the complicated charts, and just demystify this thing once and for all. By the end of this, you'll get how it all works in plain English.
Okay, first, the really quick legal bit. This is just for educational purposes. It is not financial advice. All right, let's get into it.
I want to kick things off with a question for you. Let's say Apple's stock price has a great day. It just shoots up. Does Apple, the company, actually get any richer because of that? Now, your gut might say, well, yeah, of course. But the real answer? It might surprise you.
The answer is no. Not directly, anyway. A rising stock price doesn't put one single extra dollar into Apple's bank account that day. And honestly, this one simple idea is the key to unlocking how the entire stock market really works. So, if the price going up doesn't mean more cash for the company, what is everyone even buying and selling? Let's break down what a stock actually is.
You know, at its core, it's incredibly simple. A stock, or a share, is just a tiny piece of ownership in a business. When you buy a share of a company, you are literally buying a slice of that company. You become a part owner.
That's it. That's the main equation you need to remember. Stock equals ownership. The stock market, then, isn't some magical, complicated thing. It's just a giant marketplace where people from all over the world buy and sell these little slices of ownership from each other. That's the whole game.
Okay, now this next part, this is where most beginners get totally tripped up. You see, the market kind of has two different personalities. There's the daily price, and then there's the long-term value. And you have to understand they are not the same thing.
And here's where we separate the noise from the actual substance. Think about it. In the short term, prices are just a chaotic mess, right? They jump because of a news headline, they fall because of a rumor, they soar on pure hype. It's all driven by the collective mood of millions of people. But over the long term, all that emotional static just fades away. And what are you left with? The actual business. The price will eventually, almost always, have to face the reality of its profits, its growth, and the cold, hard cash it's generating.
So here's the most important takeaway from this part. The day-to-day market is an emotional roller coaster. It's a popularity contest. But the long-term market? That's all about business. It's a weighing machine. And if you can really grasp this one idea, that you're betting on a business, not a flickering price, you've already made the biggest leap from being a confused spectator to an informed investor.
Okay, so this brings up a good question. If you're not buying that stock from the company itself, who are you buying it from? This leads us to the best analogy for understanding how the market works. Just think of it as one giant, never-ending, global auction.
Yeah, when you go on your phone and click buy, you're almost never buying that stock from Apple or Google directly. You're buying that slice of ownership from another person, or more likely, an institution that already owns it. That could be anyone. Another investor just like you, a massive pension fund managing retirement money, a hedge fund, or even an automated index fund.
So what is that price that you see flickering on the screen all day? It's simply the price of the most recent deal. It's the latest agreement, the latest handshake between a buyer and a seller on what that little slice of ownership is worth at that exact second.
And that explains why the price moves. It's pure supply and demand. If there are more people who want to buy a stock than sell it at its current price, well, the price has to go up to tempt some current owners to sell. And if more people are trying to sell than buy, the price has to drop to attract new buyers. It's just a constant tug of war.
So what causes this imbalance? What fuels this tug of war between buyers and sellers? Well, it's a constant battle between two really powerful forces. On one side, you have hard information, earnings reports, economic data, stuff like that. And on the other side, you have pure human emotion, fear, greed, panic, FOMO. The price you see is just the outcome of that epic struggle.
So let's see how this auction plays out. Imagine a seller puts their shares on the market. They say, look, I'm willing to sell my little slice of this company for $100.
At the exact same time, somewhere else in the world, a buyer is looking at that same company and thinking, I'm only willing to pay $98 for that same slice. So right now there's no deal. They're too far apart.
Now just picture that tiny negotiation happening millions of times a second on a global scale for thousands of different companies. That's the stock market. The price that's constantly changing isn't the company's value changing every second. No way. It's just a live update from this massive, lightning-fast auction.
And you know, once you get this whole global auction idea, it helps clear up a huge point of confusion for beginners, the difference between investing and trading, because they are absolutely not the same thing. A trader is trying to profit from those short-term emotional swings we talked about, the day-to-day price movements. An investor, on the other hand, is trying to profit from the long-term growth of the actual business. For most people, trying to be a trader is a really high-stress, difficult game to win. Investing is the calmer and usually more reliable path.
So what about those big, scary market crashes? Well, a crash isn't proof that the system is broken. It's actually proof that the system is made of humans. It's just what happens when that emotion of fear goes viral, causing panic on a massive scale. It's a natural, although definitely painful, part of this emotional auction.
Okay, so you know all this now. So how should a normal person even approach this thing? The good news is you don't need to be an expert auctioneer. You just need a simple, calm system to follow.
Here's a 4-step playbook that just works. First, diversify. Please don't put all your eggs in one basket. You can use tools like ETFs to own little tiny slices of hundreds of companies all at once. Second, invest regularly. This is called dollar cost averaging. Third, and this one is so important, ignore the daily noise. Just tune it out. And finally, hold for the long term. Give the actual business performance time to shine.
It really all boils down to this simple formula. When you diversify your ownership, invest consistently, and just give it time, you stop being a victim of the market's daily mood swings, and you start benefiting from its long-term growth.
So what's the big takeaway here? The stock market isn't some magical, unknowable machine. It is simply a global auction for ownership. And that auction is constantly being powered by the epic, never-ending battle between cold, hard information and raw human emotion. And once you see it that way, well, it all starts to make sense.